Hi, thanks for tuning in. Recently, I helped a great young couple refinance their home loan, but they had an additional purpose to the refinance, and that was to borrow an additional lump sum so that they could invest that money in growth assets, like primarily shares and managed funds. And that was on the back of their advice that they received from a great financial planner that I know, a great guy by the name of Michael Eikelis from Frankston Financial. Now, we thought this was a great strategy, and I wanted to have a bit of a deeper chat with Michael about this and share some insights around the possibilities of leveraging the equity in your property to borrow to invest in growth assets. Normally, we probably think of leveraging the equity in your property to borrow a deposit for an investment property or something like that, which is one of the more common uses. But if you have a great financial planner and you have the advice of someone like that that's a specialist, you might want to consider looking at other opportunities for leveraging the equity in your property. So I hope you enjoyed this chat and let me know what you think. Cheers. Thanks very much for joining me today, Michael. Really looking forward to having a chat around gearing and debt recycling strategies. It's an area where I think our businesses overlap a little bit. For the listeners that are out there today, can you just give us a little bit of an overview on your background and your business?
Yeah, great. Thanks, Michael. Yeah, great to be on and have a chat about some of these strategies. My name's Michael. I've been advising for over 10 years. I work for Frankston Financial. So Frankston Financial's been around for 30 years. It was generally a family-run business. We look after clients all across the kind of peninsula and the southeast in general. So qualification-wise, I've got my CFP and all the accreditations needed for financial planning. So yeah, the main type of clients I work with are 35 to kind of 55-year-olds, clients that just want to get ahead, have the option of reducing their working hours a bit earlier, retiring a bit sooner. And so we look at different ways of kind of building wealth outside of super, because with super, you can only access it from age 60. And so the strategies we'll be talking about today are really good to be able to have your own little nest egg outside of super that you can access anytime, really.
Excellent. Yeah, no, it sounds really good. And it sounds like you deliver comprehensive advice as well, covering off insurances and wealth accumulation, both inside, outside super, which is great for our conversation. One of the things that we want to hone in on today really is around borrowing to invest. And there's a few bits of terminology that we hear when we talk about borrowing to invest, such as gearing and as margin lending. We can talk about that later. And debt recycling is a bit of a buzzword. So can you just give us a high level overview on what debt recycling is?
Yeah, so essentially debt recycling is when you borrow against your home using the equity that you've got to invest in things like shares, managed funds, ETFs. Generally, it's a separate line item on your banking. It's a separate home loan that's for investment purposes only. And so when you log in, you can see that portion's for investing and that portion is for your home loan. And so the portion that's for investing is actually tax deductible. So over time, the goal is to reduce your non-deductible debt and increase your deductible debt.
Yeah, so your non-deductible debt will be your home loan for your principal place of residence, and then the deductible debt would be the investment loan, which for some people that could be if they buy an investment property, that could be an investment loan. But I guess when we're talking specifically in this instance, it's still an investment loan, but rather than investing in property, we're investing more in stocks, whether it's managed funds, ETFs, and the like.
Yep, absolutely. Yeah, so spot on.
Yeah. Yeah, awesome. So if there's anyone that's pretty familiar with borrowing to invest, they've probably heard of the term margin lending and getting a margin loan, which I guess it's same but different. Can you just talk about how a gearing strategy like this differs from a margin lending strategy? And are there any benefits to using the equity in your property to invest as opposed to a margin loan?
Yeah, absolutely. So with the margin loan, your security is the actual shares. Also, the interest rate's generally a bit higher, but the main catch is when there are ups and downs in the share market, if the value of your total portfolio goes down by a certain amount as a proportion to the amount that you've borrowed, the banks that provide you with the loan, they actually have the ability to do a margin call and force you to sell down some of the shares to pay down the loan to reduce their risk. And yeah, so that strategy is a bit risky because we know share markets do go up and down. And generally when you're forced to sell, it's a bad time to sell because it's the bottom of the market or getting close to it. So with an investment loan that you can borrow against your house for investing, The difference there is the security is the house. And so even if the shares go down in value, you won't get a phone call from the bank saying, hey, you need to sell down your shares to reduce your lending or exposure. Yeah, so generally a much less riskier strategy because you won't be forced to sell.
No, that makes a lot of sense. And I guess the only things that some clients may need to think about when it comes to borrowing against their property is if they ever want to refinance, that's something, it's just another loan that needs to be taken into consideration if they want to move to another lender, or if they're going to sell their property, then they're going to have to factor that in as well, that they've got that investment loan that is secured against their property, and that's something they'll have to deal with. But yeah, working in conjunction with your financial planner or mortgage broker at the time can help solve that issue.
Yeah, absolutely. So, yeah, if you were planning to sell the house you're living in the next couple of years, then probably not the best strategy if you're going to have to pay down that loan anyway. But if you're happy with where you are, you're planning to live there for at least 10 years, then yeah, it's definitely a great strategy to go with.
Yeah, awesome. So this sounds like a strategy that's great for those that are trying to build wealth. Are there any particular types of clients that this type of strategy is more suited for than others? And why might it be better suited for them compared to some other strategies?
Yep. So generally, this is great for clients in their 30s and 40s. They're your peak earning years. You've got great job security. You've probably got a bit of equity in your home and you're in a strong cash flow position. Generally, clients in their 30s and 40s, this is best for. The reason it's not as appealing for clients in their 50s is because in your 50s, you're getting closer to retirement and you'll have access to your super from age 60. So there's a lot of tax advantages of putting money into your super, which can outweigh the benefits of debt recycling at that point in your life. The other thing with clients in their 30s and 40s, you might have a savings balance that you've built up over time, and you might not be willing to invest much of that, or you might not have a large amount of capital to start with your investing journey. But by borrowing to invest, you're increasing how much capital you can start with, and then the benefits of compound interest are much greater on a larger starting balance.
Yeah. Yeah, and I guess because it's potentially a slightly riskier the strategy by borrowing to invest and just investing your own money, a longer investment horizon is really sensible in this sort of situation. So that's why clients who are a bit younger might be a little bit more suited to this. But also, it's probably a good one where thinking about, in my world, most investors are talking about property investing, which we're talking a pretty serious size loan there when you borrow potentially against your own property for the deposit, then you borrow the remainder against the investment property. You could be talking a loan of 500,000 to $1 million plus. Whereas if you want to dip your toe into the water for a gearing strategy like this into managed funds, etc., you can start with a small amount, maybe $20,000 to $50,000 as an investment loan. Would that be fair?
Yeah, absolutely. Especially for those in Victoria, there's a lot of taxes right now on investment properties, land tax, and interest rates are fairly high. Investment property is great, but it is a big commitment. Whereas, yeah, investing in shares managed funds, you can do it in small chunks. You can do it gradually over time or in a lump sum. And it's just, yeah, another way to get ahead. I guess also compared with investing in property, normally in your first 10, 15 years, holding an investment property, you're putting a fair bit of your own money in. And so if you're not in a position to comfortably put a fair bit of your own money in towards the investment property loan, then when you do borrow small amounts to invest in shares, managed funds, ETFs, it's just a very small increase in your overall loan repayments. So it's a bit more manageable.
Yeah, sounds like it's a bit more sustainable. And then I guess as time goes on and hopefully you get a few pay rises or get a better paying job, you can then incrementally increase the amount you want to borrow and invest more that way.
Yep, absolutely.
Yeah, awesome. So I guess with debt recycling, you touched on earlier, there's some tax benefits when we're talking about good debt and bad debt. So what are some of the key tax benefits to debt recycling and how would these compare to if you invested without any debt?
Yeah, so for example, let's say you've got a property that's worth $1 million and a home loan of 500,000. Now you've also got, let's say, 50,000 parked in your offset account, which is reducing the interest cost on your home loan. So one option is you can just take that 50,000 and invest it into the share market. Now that will obviously increase your total interest cost on your home loan. But that increase in the interest cost, it's not tax deductible because the purpose of that loan was to buy the property that you live in initially. Whereas if you, let's say, want to remain in the same overall debt position, then you can pay down your home loan by that 50,000 then reborrow that same 50,000, and overall you're in the same debt position, you're investing the same amount, but now that separate loan of 50,000 is tax deductible, which can offset the tax that you pay on the earnings from those investments.
Yeah, awesome. So I guess when we're talking about debt recycling, we touched on earlier that it can increase the risk when it comes to your investments because you're borrowing to invest. That means that you're leveraging a lot more than if you just invested your own money. So we are talking a little bit of increased risk because if the market falls and you have to sell, then you're stuck with a debt as opposed to just a loss. So what are some of the safeguards that you would consider when you're dealing with clients that would like to follow a strategy like this?
Yeah, so I guess first of all, you'd want to make sure that you're in a strong cash flow position and you are saving a bit of money each month. So with investing and borrowing against your home, even if the share market does go down, unless you yourself need to use those funds, you can actually keep them invested, and it's a bit painful, but if you sit tight and ride through the waves, generally it will come back up soon enough. So what you need to be comfortable with is the repayments on the investment loan itself. So for example, if your investment loan is $50,000 and the interest rate is 7%, and it's an interest-only loan, then your additional commitment to your overall lending is just another $3,500 a year, which is $300 a month. So you want to make sure that your savings capacity is at least that amount, if not a fair bit higher. And it doesn't really increase your risk when it comes to investing, because if you just invested that 50,000 without borrowing, it's still the same 50,000 that can go up and down. It's more that you do have this extra loan commitment now. And so you just have to be ready to potentially fund those extra repayments yourself in case the dividends aren't coming through for some reason or the share market's down. But in the long term, you should find that the dividends and tax savings and surplus income covers those repayments and then some.
Yeah. Yeah, awesome. So one of the things I guess you talk about with your clients then is just making sure you've got that cash flow buffer, that if something did happen, then obviously you've got the cash at hand to continue making those loan repayments and not being in an adverse position.
Yeah, absolutely. We want to make sure that no one's going on mat leave or pat leave at any time soon, that your jobs are secure, and that you're overall in a strong position with your own savings buffer and a good surplus income to be able to ride through the highs and lows of investing.
Yeah, makes a lot of sense. So we talked that debt recycling can help people pay off their non-deductible mortgage faster. And that's something you see it's spruiked a little bit. And I think some people sometimes overtalk some of the advantages about this when you just get the property guys saying, pay your house off in a handful of years. But it certainly can help you pay down your non-deductible debt sooner. So can you just explain a bit about how that process works? What's the process behind that?
Yeah, so in terms of the ability to pay down your house sooner, how that occurs is normally what you're earning, even net of tax, is higher than your interest cost, which is tax deductible. And so you end up with a bit of a surplus that you can direct towards your non-deductible debt, which is your normal home loan, and you pay that down quicker. And so as you pay down your home loan, you can then reborrow some of that equity to invest. And so over time, your non-deductible home loan goes down and your investment loan goes up. And so overall, your total debt position can remain fairly similar, but the portions of what's deductible and what's non-deductible will vary. And then by the end of the journey, I guess you end up with quite a large sum that your investments have grown to. And so you can then choose to just pay down your mortgage in one hit, reduce the loan limit. And so people tend to do that a bit closer to retirement or closer to age 60 if they've been using this strategy for a while. However, saying that, if the interest rates are fairly low at the time, then there might be a good reason to keep your loan a bit longer, because what you're earning is significantly higher than a lower interest rate, for example.
And I guess that speaks to the value of having an advisor look after this type of strategy for a client, is that you're going to have reviews with the client every year to ensure that the strategy is still working effectively, and you can help that client and guide them with that decision at the time.
Yeah, absolutely. So over time, interest rates change, your income will change, share markets move up and down. So yeah, it's great to review the strategy at least every 12 months and go, okay, are there opportunities to invest more, or have the interest rates gone up and things are a bit tight? So maybe we pause the reborrowing of the equity until a year later.
Yeah, awesome. So I guess thinking of clients that might have that large sum of money just parked in an offset account and thinking of investing that with that debt recycling strategy, Is it better to do the debt recycling in little chunks more often, or do you sometimes suggest us to invest it all in one go? What's the best way to go about it there?
Yeah, so statistically, with investing, if you do have a lump sum available and you're ready to put it into the market, generally that gives you a slightly higher return than averaging it in. Now, having said that, because you are borrowing to invest and it's a bit more painful to see your money go down because it's borrowed money and there's an interest cost associated, yeah, you can choose to invest in gradual chunks. And so the way you would do that is you would potentially borrow more than you are planning to invest day one and keep the surplus in your offset account that's parked against the investment loan. And over time, you can then use down that offset account to average into the market on a regular basis, maybe monthly or every couple of months. And that way, the money that you're contributing to the investment fund is actually still from borrowed funds and you're still getting the tax benefits of what you've borrowed. So either strategy can work, and it's better to be more comfortable with investing by doing it gradually than putting in a lump sum and then being quite uncomfortable with the fact that it's gone down 10% the next day. So if you prefer to
Yeah.
ease yourself in, you can do a combination of both. You can borrow 50,000, for example, invest 25,000 day one, and then invest 2,000 a month over the next 12 months, average yourself in. And then if there are ups and downs in the market, you won't be kicking yourself that you've borrowed this money and now it's gone down in value.
Yeah, yeah. No, I like it. And I think a good lending strategy there as well is just to explain it. You touched on it earlier about when you borrow to invest, it's a great idea to have an interest only loan to minimize your repayments. And when you do that, as you set it up as a separate loan, so say you borrow the $50,000, you can do that as an interest only loan. It's a separate loan facility with an offset account. And you can have all that money just still parked in the offset account, so you're not paying any interest on it whatsoever. And then as you drip feed that money into your shares or investments, it's only then that you start paying interest on that amount once you've actually taken it out of the loan account. So in theory, you could have that 50,000 sitting in that account fully offset for 12 months, but until you're ready to actually then start investing, that's, I think, how yourself as a planner and a broker can work really well together with a client to help them with that conversation on both sides of the fence.
Yeah, absolutely. And I guess in terms of the different loan products you can use, you can just take out a normal investment loan. You would want to make sure that it's got an offset facility if you do want to average in and not deploy all of it day one. The alternative is using a line of credit, so borrowing 50,000 through a line of credit. And correct me if I'm wrong, but I think with lines of credits, they're normally a bit more expensive on the interest compared to a normal investment loan. And then I guess also having said that, an interest-only investment loan would have a slightly higher rate than a principal and interest loan generally. But what it allows you to do is to have more surplus cash flow to put towards your mortgage, which is non-tax deductible.
Yeah, makes a lot of sense. Yeah. Typically, the lines of credit type of loans are a little bit more expensive. And as you said, yeah, interest only. First of all, when you talk about the expense of home loans, a standard principal and interest loan for your own home is probably going to be the cheapest. Then you can have an investment loan against that, which is a little bit more expensive. And then if that's interest only, probably slightly more expensive again. However, while the rate might be slightly more expensive, the actual repayments are probably lower because it is interest only rather than principal and interest, which I think for the purpose of investing makes a lot of sense because you don't necessarily want to be paying down that principal. You want to sometimes maximize the amount of debt you've got for investment purposes because that means 100% of the repayments, if it's interest only, are tax deductible generally. Now, I'm not an accountant. Don't take that as tax advice, anyone, but you can probably speak to that more or speak to your accountant if you're listening and you've got any queries in regards to that. So I guess probably just to wrap things up, mate, you've given a great explanation of the different types of borrowing to invest and why you'd want to do it. I guess we need to think of the end game here and what's the overall purpose? Like what's the ideal end game for debt recycling? So should a client really want to pay off that investment loan or potentially keep it going for tax benefits?
Yeah, it depends on everyone's situation. I guess on average, mortgages are higher these days. I guess 10, 20 years ago, people might have been able to pay off their home loan in their 50s. These days, for your average mum and dad, it might be a bit closer to age 60. And so if you are approaching age 60, and just for the peace of mind, you want that mortgage paid off, you want to have your copy of the title in your house, you can definitely use that lump sum and pay down the mortgage. I guess you need to look at it in terms of the interest rates and go, okay, the interest rates are a bit higher at the moment and the gap between the earnings and the interest cost isn't too big. So that might be a good reason to just pay off your mortgage in a lump sum, because obviously your mortgage rate is guaranteed and it's fixed and it's a steady rate. So there is kind of value in having peace of mind, even if you could have earned a little bit more. If you get to your 60s and the rates happen to be quite low at the time, then you can choose to keep it going a bit longer because you are earning more than it's costing you. But if it's a fairly big gap, then that could help you get ahead even more just before retirement.
Yeah, awesome. Yeah, mate, that's great. I think we've covered off all the essentials when it comes to borrowing to invest. I guess most people that are thinking about property, we touched on earlier, would be thinking that if you are going to have an investment loan, you're typically doing it to invest in property. So I think what we wanted to do today, which I think you've done really well, is just cover off just some alternatives that you can still borrow against your own principal place of residence. It still can be a very tax effective strategy, but you may not necessarily want to do that by investing in property. You can invest in other things, and having the guidance of an experienced financial planner such as yourself to help clients with that journey by investing potentially smaller parcels to give clients a greater comfort in borrowing to invest in smaller amounts, because not everyone wants to all of a sudden be another $1 million in debt. To do it in smaller chunks of as low as $50,000 or potentially lower can be a great strategy for a lot of clients, particularly those that are younger, that have some good cash flow, that may not have the asset base that they want at that point in time, and that can help them accelerate that asset growth.
Yep, absolutely. Yeah, great points there, Michael. And yeah, it was great having a chat today. Hope it's been helpful for everyone listening.
Just before we wrap it up, what if someone does want to reach out to you? What's the best way that they can do it? How can people find you?
Yeah, absolutely. So fairly active on LinkedIn. Just look up Michael Eikelis, or feel free to jump on our website, frankstonfinancial.com.au, and there's a bookings page, and you can book in a discovery meeting to have an introductory chat and see if we're a good fit and if it's worthwhile us working together.
Awesome. All right, mate. Thanks very much for your time, and sure everyone will get a lot out of it. Cheers.
Great. Thanks, Michael.